Hey everybody, welcome back to Grain Markets and Other Stuff. Thank you for joining me. We have a special episode today that is presented by CME Group, and I'm really happy to be able to do an episode that's sponsored by CME Group. I've done a ton of work with them over the years, dating back to when I worked in Chicago for many years. I did a ton of videos and panels for CME Group, and I'm kind of happy to continue to work with CME Group. CME Group, of course, is the world's largest commodity marketplace, and CME Group, of course, is essentially the Chicago Board of Trade, and they merged with the Mercantile Exchange, a while back. And whether you know it or not, if you're a farmer, even if you don't have a futures account, you are indirectly, in all likelihood, using CME products. You're using corn futures or soybean futures, probably through your grain buyer. When you sell corn on an HTA or a cash contract or soybeans or wheat, whatever the product is, your grain buyer probably offsets that position that they've just acquired using a futures contract. So either directly or indirectly, you're using some sort of CME product in all likelihood if you're a farmer. And we're going to talk about some of the option products today, but really what I want to do first is get into a couple of things. We want to talk about this USDA report, and that's kind of the whole goal of this deal. We have this USDA report coming up. This is the monthly crop production and WASDE report, of course. And the first thing we'll look at is pre-report estimates. I'll talk about them here just for a minute. So ahead of the report, the trade is looking for some much larger acreage versus last year. Corn and soybeans combined. Corn acreage expected to come in at 93.2 million. Last year was 90.8. Now you got to remember, we originally intended to plant a lot more corn acreage last year, but we ended up with some prevent plant and some issues. Soybean acreage expected to come in at 90 million, up sharply from 83.1 last year. So overall, you're looking for a big increase in combined row crop acreage, and a lot of this has to do with higher prices. There's a lot more incentive out there. And a lot of this expectation also has to do with the expectation for a reduction in prevent plant acreage. We've seen big prevent plant in the last 2 years. 2019, we had like 20 million acres of prevent plant. Even last year in 2020, we still had about 10 million. So we're looking for a more normal type prevent plant situation. And we're looking for corn and soybeans to pull some acres out of other crops. All wheat acreage expected to be up a little bit, but spring wheat acreage, which is a competing crop with corn and soybeans, expected to come down to about 11.6. Now, in regard to corn stocks or just grain stocks in general, as of March 1st, you're looking for lighter numbers across the board here. Lighter corn versus last year, significant drop in soybean stocks year over year, and lighter wheat stocks as well. So the stock side of it, you're looking for some friendly stuff. You're looking for some potentially, I wouldn't call it bearish, but larger acreage numbers versus last year. And the thing about this report, the reason why so much volatility is typically associated with it, is because it's actually two reports in one. It's like you get the prospective plantings report, and then you also get the quarterly grain stocks report. So you've got the like double the potential for surprises, I guess, because you've got two different reports. Now, there's always this concern about volatility on report day, what's going to happen following the report. And I've actually got a good chart to show you here. This is report day changes in December corn and November soybeans going back to 2015. And there are some years where it's quiet, and there are some years where there's a lot of volatility. Like last year, we didn't see a ton of action. Dees corn was down 2 cents. No beans were up 3 cents. Excuse me. 2019, we saw a little bit more action. We saw some downward movement. Corn market was down 13.5 cents in the December contract in 2019. No beans were down 4. We had a nice rally in 2018 on report day. Corn was up about 15. Beans were up 31. 2017, relatively quiet. You're kind of mixed. Mixed in 2016, lower trade in corn that year. And in corn, we also saw a sharply lower trade in 2015. So it could go either way. We've seen volatility in both directions over the years in this report, and this year could be no different. It could really be a deal where there's volatility, or there could be very little volatility like we saw last year. But I feel like the market's setting up for some sort of volatility, perhaps, given the fact that we've been awfully quiet headed into the report. Now, what is more important to me than the changes that actually happen on report day is what happens like in the, say, 2 or 3 months following the report. That's always the interesting thing. So what I've got here is the 15-year seasonal chart from More Research, and the green section that I've got highlighted is the report, and then the 3 months following the report. So over the last 15 years on average, the market has, this is the corn market, December corn, has kind of declined following the report, but then rallied into that, say June timeframe on average seasonally. This is not an indicator of what's going to happen this year. This is just the seasonal averages of December corn in that 3 months following the report. So it's interesting that, following the report, you kind of back off and then you rally in the summer. And a lot of that has to do with, some sort of summer crop scare event, something along those lines. And I've got a similar chart in soybeans that I can dig up here. And the action is maybe slightly different in beans, but it's not totally different. In beans, you kind of trade sideways. And then I guess you have a similar sell-off. And then you seasonally rally over the last 15 years. This is the 15-year seasonal. The 5-year, the 30-year seasonal might look a little bit different, but you'll typically, be better off a couple months after the report than you were on report day, at least according to the 15-year seasonal. And again, that's not any indication of what's going to happen this year. Past performance not indicative of future results, as we always say, but that's certainly something to be aware of. Now, you kind of got the lay of the land here. We know what we're thinking for acreage, what the trade is thinking for acreage. We know what the trade is thinking for stocks. We've seen what has happened both on report day and in the 3 months following the report. So the portion of this that CME wanted to talk about, and I think this is really good stuff if you're a farmer to be aware that there's additional risk management tools out there for you, is some of the option products that CME offers. And typically in the past, you've been confined to, if you wanted to hedge a new crop corn, you'd have to buy December options, right? If you wanted to hedge a new crop soybeans, you'd have to buy November options. That has all changed because they now offer what they call short-dated new crop options. And these have been around for a while, but I'm not sure that everybody's aware of them, and I want you to be aware of them. Short-dated new crop options are essentially options on either December corn or November soybeans in this instance, but they have different expirations. So as an example, you could buy an option on December corn that expires, say, third week in August or third week in July, or even shorter time frames than that are available now. So you've got just a ton of flexibility here. And if you go to the CME website, which I've got on my screen if you're watching on YouTube, it kind of explains this. They've got a whole bunch of information. They've got a PDF fact card that you can go and scroll through. But this is really great stuff. And I've actually got a list of, I'm going to get a little bit more specific here on these short dated new crop options. I've got a list of the expiration dates. So these are the expiration dates for short dated new crop options. So these are options on December corn and November soybeans with, again, alternate expirations. So the May set expires on April 23rd. So you could buy a December corn option or a November soybean option that expires on April 23rd. And how exactly does that function? Well, you're buying on an option on the underlying futures contract, which is, say, December corn. And then when that option expires on April 23rd in this instance, it's going to work just like a normal December corn option in that, say you own a put and it's in the money on expiration day. Say it's a 450 D's put and we're at $4 on expiration day as an example. You'll get a short futures position in the December contract from 450. It's just got a quicker expiration. The June ones, of course, expire late May. The July set expires late June. The August set expires late July. The September set expires late August. So this is really great stuff because it gives you some flexibility in terms of, like, I think the way farmers see it, the amount of money that you're going to spend on these options or this insurance against your cash bushels. And you can buy something that's has a quicker expiration, which means you're going to pay less for that coverage. So you have that flexibility that you didn't necessarily have before these options were listed a few years back. So it's been a really great tool. It's something that my customers use. I have customers who trade the real short-term stuff. I have customers that trade the stuff that'll say get them out through the end of July or the end of August. It's really a nice tool, and this is a good thing that CME came out with, in my opinion. Now, in regard to, say, old crop bushels, they also offer weekly options there is a set of uh, corn and soybean options that expire every single Friday now. So if you've got, say, some old crop bushels that you need protection on, and you're really just worried about the report, or maybe you're worried about some specific weather event or some specific potentially market moving news. These weekly options are always going to trade versus the spot month futures contract, and they'll expire. There's one set that expires every Friday, and there's good liquidity here. This is also an additional kind of tool in your toolbox that can provide you with an additional risk management strategy where, again, if you're looking to hedge physical bushels, you can spend less money to kind of set that insurance policy, if you want to call it that. I know that's how a lot of us kind of look at these options as insurance policies are against our cash bushels, in particular the purchase of put options. And it works the same way if you're an end user. Say you're a cattle feeder and you've got to buy a bunch of corn and you've got some headline risk forthcoming. You can use these weekly options or these short dated new crop options to hedge that risk. So this is great stuff, guys. I'm going to link these CME website pages in the YouTube video. So if you need to get a hold of quotes or some more information on the short dated new crop options or on the weekly options, certainly check that out. And if you want copies of any of those charts that I posted, that's all newsletter stuff. So certainly check out the newsletter if you have not already. My subscription service, of course, is available for $49 a month. You go to standardgrain.com, and that's the kind of stuff that I've got in my email all the time. I mean, seasonal stuff, charts and graphics like the chart regarding net changes on report day. We've now got subscriber-only videos that are available, and you can cancel this deal at absolutely any time. So everybody have a good day. That's the report preview. Thanks again to CME Group for helping me to sponsor this episode. Any support I get from them is really appreciated, and I like working with CME. I've been doing it for years and years. Everybody have a great day. We'll see what happens on report day.